Good morning, friends. My name is Kolajivel, Chartered Accountant, Company Secretary, Cost Accountant, Law Graduate, basically postgraduate in Commerce. We are going to discuss about standard costing today. I will read out the problem, explain the concept, then we can move to working part. JVG Limited produces a product and operates a standard costing system and value its material and finished goods inventories at standard cost. The information related with the product is as follows. Direct material 30 kgs at rupees 350 per kg, cost per unit 10,500. Direct labor 5 hours at 80 per hour, 400 per unit. The actual information for the month just ended is as follows. The budgeted and actual production for the month of September 2019 is 1000 units. Direct materials 5000 kgs at the beginning of the month. The closing balance of direct material for the month was 10,000 kgs. Purchases during the month were made at 365 per kg. The actual utilization of direct material was 7200 kg, more than the budgeted quantity. The direct labor 5300 were utilized at cost of rupees 4,34,600. We are required to compute direct material price variance, direct material usage variance, direct labor rate variance, direct labor efficiency variance. This is the problem is given. I explained the concept. There is a company. The company name is JVG Limited. The company operating its costing system using a standard costing system. The company is also evaluating the inventory at the standard cost only. The data based on standard is given in the problem. Direct material required, 30 kg is required for making one component of final product. 30 kg of raw material required for making one unit of finished goods. The direct material at standard is rupees 350. For making a final product, we need 30 kg. The standard rate given in the problem is 350. The cost per unit will be 10,500. Direct labor 5 hours required for making or completing one particular final product. Each and every hour, the labor should be paid at the rate of 80 as per standard. The cost per unit given in the problem is 400. The actual information and the budgeted is given in the problem. The actual production and the budgeted is one and the same for the month of September 2019. The budgeted quantity and actual quantity for September 2019 is only 1000 units. Direct material, the opening direct material of 5000 kgs was there, and the closing balance we have to maintain always at 10,000 kgs. That means now we are commencing the business. There is a opening balance today at 5000 kgs. We have to maintain 10,000 kgs as a closing balance. During the period, we are purchasing raw material as well at the rate of 365 per kg. This 365 should be considered as an actual rate against standard rate of 350 per kg. The direct material 7200 kgs were utilized more by budgeted quantity. Say for example, the budgeted quantity is 10,000 kgs, but the actual utilization is 17,200 kgs. That is what given in the problem. The actual utilization of direct material was 7,200 kgs more than the budgeted quantity. Whatever the budgeted quantity, but the actual utilization is more by 7,200 kgs. More by 7,200 kgs. So always the actual utilization is higher than the standard. That means the budgeted. So the direct labor 5,300 hours were utilized at the cost of rupees 4,34,600. That means is what? Actual direct labor cost is considered as 4,34,600. Actual number of hours utilized is 5,300. Now we can arrive the actual labor cost paid against the standard. The standard rate, labor rate is given in the problem is 80. Now based on this information we can arrive the actual direct labor as well. Now we can work out one by one. The first question is direct material price variance. Always the variance is measured in terms of material, in terms of labor. So here on account of material there are two different variances arising. So the first variance, material price variance, that means direct material cost variance is arising on account of material price, on account of usage variance, on account of direct labor rate, on account of efficiency. Now one by one we can work out. Right. Computation of direct material price variance. Computation of direct material price variance. In nutshell form, it can be called as MPV, material price variance. The formula is actual quantity into, open the bracket, standard price minus actual price and close the bracket. The standard price given in the problem is 350. Actual price given in the problem 365. Purchases during the month were made at 365 per kg. It is also given in the problem. So we have to compare actual price with the standard price. You have to keep in mind, we have to compare actual price with the standard price. The actual price is 365. The standard price is 350. That should be multiplied with actual quantity. Why it should be multiplied with actual quantity? Always we are measuring the variance after incurring particular activity. That is the reason why after purchasing we are comparing the actual price with the standard price. That variance should be multiplied with whatever quantity purchased during the month of September 2009 is the concept. Now from 365 you have to deduct 350. The balance will be 15 rupees. So we have purchased more by 15 rupees. That should be multiplied with actual quantity. Actual quantity is not given in the problem. So put to working note, computation of, put to working note, computation of actual material purchased and used. How many units we have produced? 1000 units. So right, make the column into two, particulars and the rupees or quantity column, outer column. Number of units produced 1000 units. Standard rate, standard input required 30 kgs in the outer column, 30 kgs. So standard quantity, total quantity required for completing 1000 units of final product is how much? 1000 into 30,000 kgs required. So go to outer column and update 30,000 kgs. In the problem specifically given that we have used 7,200 kgs more than the budgeted quantity. So add 7,200 kgs, 30,000 plus 7,200. That means is what? Actually we have to purchase 37,200. Why? Because the actual utilization is more by 7,200 and the standard quantity required for completing 1000 units of final product is 30,000. So that we have to add 30,000 plus 7,200. Actual quantity required is 37,200. How much? 37,200. 200. So there is opening balance available and closing balance we have to maintain. So add closing balance 37,200. In addition to 37,200, we have to add 10,000 cages. Why? As per the company policy, always we have to maintain at least 10,000 cages of raw material. That is the reason why we are adding. So 37,200 plus 10,000, 47,200. So that many cages we have to purchase. One more information is given in the problem. What is the information? Opening stock available in the factory is 5,000 cages. So that we need not to purchase that cages once again. So that can be utilized for consumption purpose for the month of September 2019. So available quantity should be deducted. So less opening stock. That is the reason why opening stock is deducted. So 5,000 cages. So now the resulting figure is how much? 42,200. That means is what? Actual quantity purchased is 42,200. Now go to computation area. Update actual quantity purchase is 42,200. That should be multiplied with standard price minus actual price. The resulting figure would be 6,33,000. That should be called as adverse. Why it should be called as adverse? Why? Because the actual price is more than the standard price, so that it should be called as adverse to the company. Then next part, direct material usage variance. Direct material usage variance. So due to usage there will be variance. That variance may be adverse or that variance may be favorable to the company. So write computation of material usage variance. Material usage variance. The formula is standard price into open the bracket standard quantity minus actual quantity close the bracket. Standard price given in the problem is 350. Update 350. Standard quantity is not given in the problem straight away, but instead all indirect information is given in the problem itself. So what is the budgeted and actual quantity? 1000 units we have completed as a final product. Each and every unit required 30 kgs of raw material. So multiply 1000 units with 30 kgs, you will be getting 30,000 kgs. So the standard quantity required for actual production will be 30,000 kgs. So update 30,000 kgs minus actual quantity is how much? 37,200. How much? 37,200. 30,000 quantity standard, but we are consuming more by 7,200. So we have to add 30,000 plus 7,200. The resulting figure would be actual quantity. So 37,200. Actual quantity consumed 37,200. So deduct 37,200 minus 30,000. That should be multiplied with the standard price. How much? The resulting figure would be 25,20,000. It should be called as adverse to the company. Why? Because as per the management policy, the management has set the standard 30,000 kgs of raw material to be consumed. But how much we have consumed? 37,200 kgs is consumed. That means is what? More by 7,200 kgs consumed by the company is adverse to the company. So it should be multiplied with the standard price. Why? Why? Because always standard price should be taken for measurement purpose. So actual should not be taken. Why? Because the actual price will be keep on changing each and every day. So that should not be taken for measurement purpose. always we have to measure the difference between the standard quantity with actual quantity at the standard price is the concept. What is the next question? Direct labor rate variance. Write the heading computation of direct labor rate variance. So here we have to compare two rates, standard rate and actual rate. So difference between the standard rate and the actual rate should be multiplied with the actual hours is the concept. Write the formula actual hours, write the formula labor rate variance or L or V is equal to actual hours into open the bracket standard rate minus actual rate and close the bracket. Standard rate is given in the problem is 80 rupees. Update. Actual rate is not given in the problem but indirect information is given in the problem. How? The actual labor cost utilized direct labor 5,300 hours were utilized at the cost of 4,34,600. It is related information for this. So 4,34,600 divided by 5,300. Both the thing is actual. That means actual direct labor cost divided by actual number of hours utilized. You will be getting a rate, actual rate. How much? 82 rupees. Update. So the actual rate is 82 but the standard rate is 80. That means here also 2 rupees is more than the standard. It is also adverse to the company. So that should be multiplied with the actual hours taken for completing this particular assignment. So how many hours are taken by the labor? 5,300 hours. So 80 minus 82 should be multiplied with the 5,200 actual hours taken for completing final product. So the resulting figure is 10,600 rupees. 10,600. It is also adverse to the company. Why? 2 rupees is paid more than the standard. You can ask, sir, why actual hours should be taken instead of standard hours here? Why? Because actual hours taken for completing a final product should be taken so that we can measure the labor rate variance. Then what is the next variance? Direct labor efficiency variance. Computation of direct labor efficiency variance. The formula is standard rate into open the bracket standard hours minus actual hours. Standard rate is given in the problem is 80. Standard hours is not given in the problem directly but indirect information is given in the problem. How? 1,000 units of final product we have made. Yes or no? Yes. So 1,000 units of final product. Each and every units required 5 hours. So multiply 1,000 units with 5 hours. The resulting figure will be called as standard hours. So standard hours is how much? 5,000 hours. So actual hours given in the problem straight away. You can update 5,300. So the standard hours for completing the 1,000 units is 5,000 hours but the labor has taken 5,300 hours for completing 1,000 units. So 300 hours is more by the standard. So it is also adverse to the company. Now deduct 5,300 with 5,000 labor hours. That should be multiplied with the standard rate. The resulting figure will be called as labor efficiency variance. How much? Rupees 24,000. It is also adverse to the company. Why? Because more hours is taken. More hours is taken. Now you can ask, sir, why it should be multiplied with the standard rate? Already we have discussed always the rate should be taken with the standard rate. Why? Because it is a constant to the company. It will not be getting changed periodically unless otherwise extraordinary situation is arising in the factory. So that standard rate is taken instead of labor rate. Labor rate keep on changing actually, so that should not be taken. Whatever standard is prescribed by the management, that should be taken for computation purpose and a comparison purpose, so that there will be a consistency always. So standard rate should be multiplied with the actual hours minus standard hours. The resulting figure would be direct labor efficiency variance, that is 24,000 rupees adverse to the company. What are the things we have learned today? How to compute direct material price variance, usage variance, rate variance, and efficiency variance. I hope that you'll be enjoyed my session. Thanks for your support.